Well, this isn't exactly a great question, this next one, but it should be easy because I'm sure it's top of mind for all of you. What are you most excited about for Q4 and going into 2023?
So from my side, this is the moment to invest in startups. Fortunately for an investor, sometimes unfortunate for the startups, but because I've seen 40% discounts on the evaluations. But that's the reality. We've always been a fundamentalist investor and not much of a FOMO investor. So I think going back to basics is the time for investing right now. And I'm very excited about that. I'm very excited about startups going ahead of this turmoil and trying to raise money from around the world in general. And next year, I think this is an economic correction, at least in our community, in our vertical, because private capital, we've done it. I mean, compared to public capital, we're the guys right now. So I'm very excited about being a private investor to private companies.
I share a lot of those thoughts. I think in our space, everybody's aware of a few phrases. When the tide goes out, you're able to figure out who knows what they're doing, so to speak. And in our world, people were able to pump dollars into digital advertising and just automatically get revenue back for a really, really long time. And I think a lot of people had lost focus on the fundamentals of running a business and gross margins and really building a foundation for a business that could scale. What we're excited about as a strategic resource firm that tries to drive a ton of value is being able to lean in to be able to help our portfolio companies continue to grow and grow efficiently. And then also, I mean, you can't help but recognize that valuations have been reduced. And for people that sit where we do, that's great for us and for our limited partners. So Q4 should be a really active time for us from an investment standpoint and also from a portfolio support standpoint. So it'll be a busy quarter and a lot of exciting things.
Yeah, I mean, echoing both of their sentiments, we've been more active this year than we have 2020 and 2021. And we'll continue to just raise Fund 6. So one of the things I think that can somewhat be a misconception with venture is venture capital firms are startups too. I was talking to a plug for a couple other investors I see out there too that are here in Austin now, but I was talking to Han Shen with iFly, and he's built a great venture firm, and it's very much of a startup to start. I can't necessarily claim that because I joined Fund 4, but from our fellow colleagues and founders of our firm, that's absolutely the case. I think we're back. We're not even back. I think we've said kind of preach fundamentals. Two of our partners have seen .com and Great Financial Crisis, so they've been investing in startups. They had investing that really were founders first too. So it's back to not even back to it's fundamentals, right? Like you were saying, gross margins, and I think it's thinking about extending burn and not raising growth capital until you need it. I think what got out of hand the last couple of years was probably more so on the growth side, let's say on the seed side. Valuations may have, but I think it was more of a mindset of not spending significantly until you've found the sales motion and product market fit. And so a lot of what we did the past 2 years was we focused on our lab, Mucker Labs, which is, I mentioned. I won't talk more about it, but if you want to hear about it, feel free to ping me. But it's kind of a hybrid between a studio and accelerator. And so we did a lot of investments out of there. Lean, scrappy teams that were looking to build businesses, and the ones that ironically kind of came out and have raised pretty good rounds this year didn't really get caught up in the hype of the last year or two, which wasn't necessarily ironic, but I think if you asked us a year ago, we wouldn't have necessarily thought that. So I think the thing that I've learned the past couple of years is just really around don't raise the growth capital until you really feel like you've got the fundamentals, the sales motion, the go-to-market, kind of leading to your product market fit in place.
Yeah, I don't have tons to add. I mean, I would just say if you look at some data that came out, PitchBook MBCA released their Q3 report a few days ago, and what that shows is deal volumes and capital deployed while it did drop off, so it was about half, and their data always lags. So their Q3 data is really the Q2 data because of when deals got reported. But so, well, you say Q3, but talk about Q2 is really half of Q1 in terms of capital deployed and deal volume. But that was still equal to pretty much every quarter's deployment in like 19, 20, and 18. And 18, 19, 20 were, I know 20, easy to forget, short memories, were like banner years for venture capital investing. And so I think one side of the coin is, I don't know if the trend's positive. So like in 2 quarters, it may be significantly down and we may be totally in a, hard capital environment. But as hard as the capital environment feels right now relative to a year ago, we're really, I think, just starting to revert back to the mean. At least last quarter, this quarter, and who knows about the next couple quarters. I think if the next couple quarters are significantly down again, one thing that's, exciting, and this is something that I say this with lots of empathy for companies fundraising, because it is, again, much harder now than it was before, especially if you raised money last year and were valued last year. So I say this with all the empathy, but like, I'm excited. Like, this is the time where, market leading decacorns get built. If you look at prior cycles, like Netflix, Uber, even Google, were all founded and in their early stages right as prior crashes happened. The 2000 crash happened and the 08 crash happened. And what that did was it basically, their weaker competitors went away and let them own the markets. And so I think for strong companies that are well capitalized or can get well capitalized like quickly, like you should go do that. Because having a war chest while all your competitors are struggling is going to be really, really valuable. But you can build a really valuable company over the next 24, 36 months that would have been harder to do in the capital environment of a year ago, where there was so much money being thrown at everything. You were competing against irrational competitors.